When it comes to real estate investing, one question typically comes up. Should you focus on cash flow or appreciation? Well, the truth is you need both, but depending on where you are in your investment journey, one might matter more than the other. So let's dive in this video. But before I do, don't forget to like this video and subscribe if you enjoy this content. And if you want to chat one-on-one, feel free to book a call with us. Now, let's start with cash flow, especially for new investors. When you're just starting out, cash flow is key because it does help you cover your mortgage, your property's operating expenses, and even some of your lifestyle. Retirees like to look for cash flow, but it's even more important for investors who don't have a lot of wealth built up yet. Strong rental income makes it easier for you to grow your portfolio because you're not constantly putting money into the property. You're actually earning cash from day one. Now, if cash flow is your focus, cities like Calgary do stand out. Right now, Calgary's multifamily cap rates are around 5.5%, while in Toronto, they're closer to 4.25%. That means rental incomes are definitely typically stronger in Calgary, making it easier to cover costs and qualify for financing. And for new investors looking for lower upfront costs and better cash flow, Calgary or Edmonton might be the way to go because they are cheaper and generate better cash flow. But cash flow is not everything. If we look at appreciation trends from 2005 until now across Canada, Toronto consistently outperforms Calgary. Now, even if you earn an extra 1% in rental income per year out west, Toronto's property values have historically grown about 4% more per year. So over time, that adds up to a much bigger return. And don't forget, appreciation is taxed at a lower tax rate compared to rental income, so you get to keep more of your gains. Now, let's talk about Toronto specifically because that's where we like to invest, and talk about condos versus houses. We all know what's been happening with Toronto condos lately. Prices have already dropped quite a bit, and now they are pretty stuck. Condos attract mostly investors, but these days, they just don't make sense as investments. High negative cash flow, little price growth make them a tough sell. And at the same time, sellers don't want to take big losses, so listings are just sitting on the market stale. So does the usual rule, lower cap rates and higher appreciation, still apply to Toronto condos versus houses? Between 2010 and 2020, condos did see huge price jumps. Investors were flipping pre-cons for big profits, so they didn't really care about negative cash flows. But when interest rates spiked in 2022, that ended pretty quickly. Condo prices corrected in 2022, and they're probably still trying to find a resting point. Now, if you look at this chart since 2005, houses did appreciate more than condos in Toronto in the long run. And that's because more end users buy houses, whereas condos attract more investors and even speculators. Plus, land in Toronto is limited, so not so much room for new houses to grow, but demand for houses do keep growing while new condos can grow and keep getting built. On top of that, houses usually do have better cap rates since you're not losing rental income to condo fees. And if you split a house into multiple units, you get even stronger rents. Now, even though Toronto's average cap rate is around 4.25%, we are actually seeing much better real deals right now. In Toronto's buyer's market, cap rates of 5% to 6% are actually possible with the right property and a motivated seller. And that's similar to what you would find in Calgary, but with Toronto's stronger appreciation, it does give you the best of both worlds. And if you want to take things a step further, value add projects in Toronto make even more sense. Renovation or construction costs are pretty similar across Canada, but because Toronto's property values are higher, your return on investment is much bigger here in Toronto. Here at Elevate, we do focus on Toronto multiplexes because they do give you both strong cash flow and strong appreciation. Here's an example. you can buy a semi-detached house in Toronto for around $800,000 these days. And then you would invest another $150,000 to convert it into 3 units. And after that, you might get a value add lift of $150,000. Once you're done, you end up renting it out and you can generate around $1,500 in monthly cash flow. And then you also have the potential to build a backyard house as well. And once you do that, your rental income and cash flow go even higher. So if you are thinking about investing in Toronto multiplexes and you do want to see your options with us, let's chat. We don't guess, we run numbers and show you how exactly to make the right investment move. Whether you're interested in a fully renovated turnkey property or one that can be converted into a multiplex, we'll guide you through every step of the process to make sure you're making the right move. Here's how it's like to work with our team. We'll take the time to understand your goals, crunch the numbers to find you the best investment opportunities, and then help you land the right property for you. If you want to dive into renovations, we can connect you with trusted contractors and guide you through the process. And once everything is done, we can even handle leasing and property management too. Are you ready to get started? Just head over to this link here and let's chat.